Hey everyone, in this video I'm going to show you how to pick the best contracts for your trades, no matter if you're a day trader, scalp trader, swing trader, and no matter what stock you're looking at. We're going to go over exactly what you should look for and what I look for on a day-to-day basis when I'm picking out trades. So I pulled up the Tesla option chain here. First thing you want to do is make sure you have all the available strikes for the stock that you're looking at when you're pulling up a stock's option chain, so you get to pick the best option. Next thing you want to do is make sure that you can see the volume, delta, theta, and the open interest, because the bid and the ask price columns are always going to be there, but these may not. So go whatever broker you're using, just make sure you customize your settings by doing, for example, I'm on Thinkorswim, so I just click on this layout, customize, and then I can add these columns. So first things you want to look for is making sure you pick a contract that has good tight spreads, or as tight as spreads as you can possibly have. So stocks like Nvidia, Netflix, Roku, Zoom, they typically have spreads that aren't the best. They have spreads that are like $15 to $20 or more apart. When it comes to day trades, I don't pick a stock that has more than $20 worth of spreads. And what I mean by spread is the difference between the bid and the asking price. So in this case, this right here I would go for because the price is 460, the bid is at 460, the ask is at 470. So I know that I can get a good fill in between, and I know that if I'm trying to enter and I'm trying to get out of the trade with tight spreads like this, I won't have a problem. So another thing I look for is the volume. So the volume is going to indicate how tight the spreads are usually going to be and the interest for that contract. Okay, so if we scroll down here, if I scroll down a little bit here, see how these stocks, yes, they have low delta, but also those stocks that have, like for example, this strike right here, 845, right? 845 call has only 236 volume, and that's why look at the difference between the bid and the ask, right? It's farther apart compared to stocks that are here. Even this one, they have the same delta as you can see, zero point zero 0.01, zero point zero 0.01. But the difference is you got 236 volume versus 1,576. And because it's got so much more volume, look at the spreads, 0.20 and 0.26. So those are tight spreads. Another thing you want to look for is the delta. So when it comes to delta, when it comes to my day trades and scalp for day traders and scalp traders, for me personally, I like to look for delta of at least anything over 20. At least 15 to 20 would be a decent amount of delta if you're trying, depending on what type of play it is, obviously. If you're a scalp trader, you may want to look for the upper deltas of like maybe 30 to 40 range or 25 to 30 plus. But for me personally, for day trades at least, gotta have at least 15 or more delta because we want some kind of movement. What delta does, for example, if I'm taking a look at, let's say Tesla strikes 720, this is a contract that I would play because it's got really strong volume, 18K volume, 16 delta, so it meets my requirement of being at least 0.15 and above. It's got tight spreads, right? Under $20, it's $15 apart. It's got high open interest. What open interest means is how many people currently have this contract already open in their positions. This is how many people, like for example, I don't own it yet, so I wouldn't be considered a part of the open interest. But open interest means for all the people that already own it and are currently still holding it and have not sold yet. That's what this shows right here. The volume is basically all the orders that are coming in for this contract. So market makers, individual like retail traders, institutions, whatever, these are the orders that they've placed to get into and out of this contract for this strike 720 calls for Tesla. Now, when it comes to day trading and scalp trading, I don't look at data too much because I already know what type of play I'm gonna make. Any good trader will have a tight stop loss or at least a stop loss, some sort of stop loss, to make sure that your contract doesn't, lose value too much, and the theta decay won't kick in much for scalp traders and day traders. But if you're swing trading, you definitely need to consider what the theta is. I'm gonna get into theta decay later. So that's Tesla. Let's pick a stock like BA. Okay, keep in mind, the more expensive the stock price is, the worst options you're gonna have to pick a good contract. And it all depends on the day as well, because this is a weekly expiration date, right? So this contract expires July 9th. Currently today, as of this recording date, today is July 5th. So starting when the market opens, this data decay is going to kick in, and the contract price is going to decrease as we get closer to Friday. As you get closer to Friday, or as you get closer to any expiration date of a contract, the spreads of your contract are going to get tighter and tighter, which means they're going to get smaller and smaller. And the delta is typically going to increase depending on what strike you're playing as well, but typically the deltas are higher, and the theta decay will typically increase as well, or decrease as you get closer. So let's take a look at another stock like BA. So remember, keep in mind we have Tesla at 678, and let's take a look at BA. So BA is a $236.68 stock, and now let's take a look at the options that we have here. As you can see, for the same price, remember our range for me, I pick contracts that are between $100 and $300 usually for my day trades and scalp trades, and I look for that high delta movement. So here I can pick this contract right here because we have really high volume, 14K volume, strike 240. It's very close to the money. Bid in the ask is 173 to 188, not too bad, and we have 0.35 delta. So I know that that's going to help me a lot. So the delta, what delta does is it's going to add to your existing price value. So whatever price of the contract was at the time you purchased it, every dollar move that BA does on the upside, since we're looking at calls, my delta is going to be added to my bid, or added to my contract price. So if I fell at 1.70 and BA goes up a whole dollar, then my contract's going to be worth $205. Does that make sense? So that's how you do the math. And there's a lot of online tools that you guys can use as well. Option calculators. You guys can Google to pick and choose what type of contracts you want. But just on the fly, as you're looking at the option chain, that's what you look for. When I take one look at this, I want to look for stocks that I know that I can afford, or contracts I know that I can afford. And you got to also consider contract fees. Everyone has a different account size, and most brokers charge anywhere from 50 to 60 cents per contract, and that's every time you buy and sell it. A lot of people think that, for example, on TD Ameritrade, their default fee for contracts I think is 60 cents or 65 cents. But that fee is actually every time you buy and sell the contract. So that ends up being $1 or $1.20 in commissions just for taking that one contract, one position of that contract. So when I take a look at this, yes, for example, the difference between strike 240 and strike 245, not too much because they're still both close to the money, right? But look at this, the volume difference, right? We got double the volume comparison. Delta is also basically double as well. Data is not too bad. Open interest is not that much of a difference. But look at the price of the contract, 0.72, 0.77. So as a scalp trader and as a day trader, the clear best option would be the ones closer to the money because that's going to make you more money. Your contract is going to be worth more as the stock price of BA continues to go up. And you don't have to, depending on your account size, if you're used to buying 10 or 20 contracts per trade, you're not going to pay as much in fees as you would buying this strike right here at 245. So you got to look at those considerations as well. Now let's take another look at stock price NEO. So as you guys can see on NEO, for example, on July 9th, so the closest strike to the money, 51, and we have 23K volume. We have 0.45 delta. Data's not too much. Decent open interest, and look at the spreads, 144, 147. So when it comes to this is where you can start doing market orders if you wanted to, realistically. I only do market orders on options trades when the spread between the bid and the ask is at least 5 or under, because I don't want to miss an entry and risk risk the contract price going up too fast because they're always going to have high delta, typically, usually the ones I pick, and I don't want to miss out on the trade and chase the trade with a higher fill. So if I see that the bid and the ask are really tight, I'll just press buy market as soon as I want to get in, and then when I want to sell it, I can sell at the asking price or the bid price or do another market order again, knowing that I'm usually going to get filled pretty easily. So on NEO, we have really high volume, really high delta, good open interest, tight spreads, and that's the one this is what I would pick for a day trade or a scalp trade. This right here. Now let's take a look at swings. So if I'm taking a look at swing trades, keep in mind, watch the data decay, right? So let's say you're taking a look at stocks like Nvidia. Okay, so if I scroll down on Nvidia, already you can tell Nvidia, even the ones with the higher volumes and stuff, they don't have the best spreads. Let's take a look at this for example. Strike 840 has 1500 volume, 27 delta, so it's got pretty good delta. Data decay is high, negative 1.07. Uh, Decent open interest, and look at the spreads, 490 and 520. Remember what I said, when you're looking at a day trade or a swing or a scalp trade, you do not want to enter a contract with more than 20 spread difference because you want to get the best fills for when you're getting in and out of that position. And for swing trades, I typically look at that. Also for swing trades, I look at the same thing. I'll make sure that the spreads are not too bad. But for swing trades, you can get away with getting a contract that has not the best spreads because as swing trades take time to develop, usually for most traders, and as the value of the swing trades go up, you can always set limit orders to fill in between at whatever price you want. And let's take a look at Nvidia for example. Nvidia July 9th expiration date. You can tell the spreads aren't the best, right? And the prices of the contracts for what you get are decent stats. Now, if we go farther out, let's say we go a month out. So instead of July 9th, I pick August 6th. So if we scroll down, you can already tell that the prices are insane, right? These are all $1,000, $2,000, $3,000 contracts. Now, if we try to go for something that's affordable for our range, here's the difference. The delta is not as high. Look at the spread, 3.15 and 3.50. That's really high. Okay, so this is not a contract that you would want to get. Low open interest, low volume, not that much volume. And when it comes to swinging tech stocks that are more expensive, you want to be careful because, as you guys know, market makers they change the way the way the current market conditions are. You can go up and down 20 points on any given day for a lot of these tech stocks like Nvidia, Netflix, Roku, Zoom. All these tech stocks are gonna have not the best spreads, and to swing trade them is gonna be difficult. And you also got to keep in mind that the data decay is a rate of how much your contract is worth less and less per day. So if you buy a contract here, let's say you fill at here for strike 485 on Zoom. Zoom is currently worth 387 or 388.89. So if Zoom doesn't get anywhere near here, if your strike price that you bought does not get closer to in the money, that contract is going to lose a lot of value every single day that you're wrong. As every single day that the data decay is working against you. So you always want to make sure that if you're swing trading, make sure you swing trade something that realistic, get close to the money as possible with your swing trades. That way, for example, let's take a look at a stock like NEE. So these are all. So if I pick August 21st, yeah. So if I pick August 21st, look at this. This is a swing trade that I would love to do. Why? Because the stock price of NEE is $74.28. If I swing for strike 75, I know that I have a whole month, basically a month and a half, to get to that point. And depending on the chart, if I think it's a good trade, I would go for this contract. Why? Because it's got high volume, really high delta. Look at the data decay, negative 0.02. That's really good for a swing trade. That means that I don't have to worry about the contract working against me every day that I'm wrong. It's got really high open interest, and the spreads are only $10 apart, right? 180, 190. So that's a really good contract that I would love to swing. It's close to the money. It's going to make me money really fast if it goes up. And let's say NEE goes past $75, goes to 76, 77. My delta is going to be worth even more and more as it goes deeper in the money. And it's going to give me more profits. If we take a look at stock price NEO, if I want to swing a NEO contract, same thing. NEO, August 6th. Let's take a look right here. Let's pick. What I would do is I would probably go for, let's see, not August 6th. I go with this one. So this one's not too bad. It's got a spread of 30, 3.80, 4.10. It's got a realistic strike price of 52. So can NEO right now it's $50.40. So can it realistically reach $52 from a month and a half from now? I think yes, based on the charts that I've been looking at, I would say yes. It's got 249 volume, really high delta. The data decay is not that bad, decent open interest. So this is a contract that I could get. Now keep in mind what I taught you about swing trades. When you're looking at a swing trade contract, you can always set your limit order to whatever percent profit that you want to take. So all you got to do is, even if you have bad spreads on it on a given stock or on a given option contract, you can still fill automatically if you set a GTC order. So what that means is it's good till you cancel. That's what GTC stands for. So when you're setting limit orders, there's two types of trades. There's GTD or GTC. GTC means good till you cancel, and then the other one I think is good till the day, till the end of that trading session, and then that order goes away. So that's what I would do for stocks like this. And this is how you pick the right contract for no matter what type of trader you are. You can take a look at any of these stocks. There's another famous one, Roku. And you also got to be careful not to swing a lot of the most volatile stocks that have terrible contract stats, meaning that they have horrible Greeks, their delta data, and the spreads on them are bad. Let's take a look at Roku, for example. If I take a look at Roku Strike 460, okay, 1200 volume, 16 delta meets the requirements, strong data decay, and the bid in the ask is 210, 225. Okay, so it's a 15 spread difference. Okay, that's for a day trade and a scalp trade. This is something that I could live with. But here's why I wouldn't swing trade this. Okay, so let's say strike 460, we want to swing trade this contract. So if we go back here, we pick strike 460. Look at the difference now. Okay, the volume 226, the delta is higher, the data decay is negative 0.53, the contract is $545, and the spread is the ask is at the bid is at 545, the ask is at 570. So although the spreads are not too bad, the main thing that works against you is the data decay. Can Roku realistically go up $30 by next week, or even get close to it, to make sure that your contract goes in the money? Because if it doesn't, you're going to be losing 0.53, so that's $53 per day that you're wrong on this contract right here. And that's a lot of things that people don't realize about data decay. When you pick a contract, people think just because you're down 20% or 40% or even 60% on a trade, that, oh, it's going to recover. I still got time on it. I still got time on it. But just because you pick a farther expiration date does not mean that you're always going to be, that trade has a potential of recovering all the time. Okay, because you could, depending on the price of the contract, if it's an expensive one and you don't understand data decay that much, um, the trade could really work against you. There's a lot of traders that I met over my years of trading that swing trade or pick bad contracts, and they lose more capital than they ever wanted to when investing in the stock market because they don't understand how contracts truly work. You have to understand that you got to pick first every time you enter a trade. Know what type of trade you want to get into. If it's a day trade or a scalp trade, only trade weekly contracts, the nearest expiration date for day traders and scalp traders. So that primarily that's what I do. I'm always here on the closest to the week expiration date for no matter what stock I'm looking at. If I'm swing trading, when I swing trade, I like to pick stocks that at least give me like at least 3 weeks or more on my time. Because when I pick stocks that are 3 weeks or farther out, the data decay is not that high, and I make sure I set for realistic strike prices. And of course, everybody's got different account sizes, so you have to make sure, can you afford that contract? Okay, so if Roku is worth 430, and you pick a strike or expiration date for the end of July, and you want to get close to the money, well, look at the prices of these contracts. They're really high, and the spread between the bid and the ask is awful. So that's something you got to consider. Okay, the data decay is still pretty high as well. It's not like it's nothing, but because the price of the contract is really high, you have a lot more time. You have a lot more time for the contract to not be completely worthless. Okay. So I hope this video helped you guys. Make sure that you only look for things with good volume, good delta, tight spreads, at least $20 or less, and you make sure that you don't pick a contract that works too much against you. Set for realistic strike prices. set for realistic expectations, and know what type of play you want to get into before you pick a contract. All right. And if you guys have any questions, let me know. You can leave a comment below this video if you want me to explain more further in detail, if you have any questions, and I'd be happy to help. Thank you for watching.